If you think the fastest way to pay off a mortgage is to make additional monthly payments directly to the principal portion of your mortgage, then you need to watch this video. So how can we pay off a mortgage as rapidly as possible? Well, before we get into that, let me first talk about who should pay off their mortgage rapidly. So in my opinion, there's 4 different criteria that need to be met before you consider paying off your mortgage. And the first one is that realistically, your mortgage is probably the cheapest loan that you will ever get. So if you have any other debt, you should pay that off first. It doesn't make any sense to pay off a 3% interest mortgage if you have 20% interest credit card debt hanging over your head. So pay off all of your other debt first. Make sure you pay off all of your credit card debt, your student loans, your car payments, your medical expenses, whatever kind of debt that you have that's a higher interest rate than your mortgage, which is probably all of your debt. Make sure you pay that off first before you start tackling this low interest mortgage. The second criteria is if your job offers a matching 401k contribution, you always want to take the match. So if they offer a 1-to-1 matching contribution up to, let's say, 5% of your salary, then you want to devote that 5% of your salary to the 401k and get that matching contribution. Because when you get a matching contribution, your employer is essentially kicking in as much money into your retirement account as you are. You are literally doubling your money on day one, and you're not going to beat that with any other system. Number 3, you want to have an emergency fund set up. Most people recommend somewhere between 3 and 6 months worth of living expenses, easily accessible, just in case you get hurt, you get sick, you get fired from your job. Whatever kind of curveball life throws at you, you want to have enough money on hand to be able to survive those bad times so you can get back on your feet. And lastly, I would actually highly recommend that you max out your Roth IRA and an HSA account if you're eligible for one before you start contributing additional money to your mortgage. A Roth IRA is a retirement account that provides a lot of different tax benefits. It's going to help you save very efficiently for retirement. Now in 2021, the maximum that you can contribute to your Roth IRA is going to be $6,000 a year. And if you're eligible for an HSA, a health savings account, I highly recommend that you max that out as well before you start thinking about paying down your mortgage. All right, so let's assume that you meet those 4 criteria and you want to actively pay down your mortgage as rapidly as possible. What are the absolute best ways to become debt-free and get rid of that mortgage fast? So what are some tips that actually help? Well, the first thing is maybe refinancing your mortgage would be beneficial. If you got your mortgage a handful of years ago, you may have been charged maybe 4 or 5% interest rate. And that's a big deal because the current interest rates are probably closer to 2.5% to 3% interest. So simply by refinancing at a lower interest rate, you could theoretically save thousands of dollars. Now, if you do refinance and your monthly mortgage payment goes down, continue to make the same higher payments that you were used to. So for example, if your old mortgage was $1,000 a month and now your new mortgage is only $850 a month, keep paying the full $1,000 a month that you were used to. You've already got it budgeted into your account, your lifestyle. It's not going to affect you in any way, but it is going to ensure that you pay your mortgage off rapidly. Other things you might consider when you're refinancing is instead of getting a 30-year term, maybe getting a 20 or 15-year term might be better. Sometimes the interest rate is a little bit lower if you do a shorter period of time. And this can also be really beneficial if, let's say, you've already had your mortgage for 10 years on your old 30-year mortgage. You may not want to refinance it and reset your mortgage back to a 30-year loan. So instead, if you're going to refinance to a lower interest rate, just ask your bank for a 20-year mortgage term duration. And if you're going to refinance your mortgage, you might consider using a bi-weekly term instead of a monthly term. So most mortgages by default you're going to be paying once a month. But there's also an option where you can make payments every other week or bi-weekly. Now let's say that your original mortgage was $1,000 a month. Your bi-weekly payment would be $500 every other week. And this can be helpful for a lot of people because a lot of people get paid every other week. So by having a smaller mortgage payment during every paycheck, it helps you to balance and manage your budget a little bit better instead of having a ton of money coming out at the first of the month and then nothing coming out in the middle of the month. It sort of evens out that payment a little bit. And by having a bi-weekly setup, essentially the way the math works out on it is you end up making 13 full payments towards your mortgage every month. So instead of making 12 payments at $1,000, you would be making 26 payments at $500, which turns out to be essentially the same as 13 payments at $1,000. So you make basically one full extra payment to your mortgage, and that obviously is going to go directly towards the principal and pay your loan down faster. Another great way to pay down your loan faster is just to simply put extra money towards your payment each and every month. It's not rocket science. The more money that you pay to your lender every month, the faster that loan is going to get paid off. So let's take a hypothetical example. Let's say that you have a mortgage of $200,000 at 3% interest rate. Now the principal and interest payment of your mortgage in this case would be about $843 a month. And over a 30-year duration you have repaid this full $200,000, but you would have been charged over $100,000 in interest. That's a lot of money. How can we get that number down a little bit? Well, if you just contribute an extra $100 a month towards your mortgage payment, so instead of paying $843, you're going to pay $943, then that extra $100 a month is going to save you almost 5 years off your mortgage. So instead of paying it off in 30 years, you're going to have it paid off in 25 years and 3 months. And in doing so, you're going to save over $18,000 in interest. Now that's pretty good, being able to pay your mortgage off 4 years and 9 months faster, but there's a better way yet in order to pay off your mortgage. And the reason that this works is your interest rate on your mortgage is so low that you can actually gain more money by investing in other assets instead of simply paying down your mortgage rapidly. So let me explain how this would work. So in the long run, the stock market tends to average roughly a 10% rate of return. Now this is volatile. Some years are better than others. Some years you might make 20%, some years you might lose 20%. But in the long run, the stock market has averaged roughly 10% per year. Now remember, when a mortgage, we're talking about a 20 or 30 year duration. We're not talking about a short-term thing. We're talking about decades for the averages to kind of play themselves out with this stock market. So instead of just taking that extra $100 and applying it to your mortgage, what if we just invested that $100 a month into a broad-based index fund that mimics the broad stock market? So basically we're taking this extra $100 and letting it grow and compound until it has grown large enough that we can just simply take the money out of this stock market account and pay off our house in one lump sum payment. Well, if we just take this $100 a month and invest it at a hypothetical 10% average rate of return, and we do this for 30 years, the duration of our normal mortgage, then over that 30 years, we would have $170,000 in this stock market account. And that's a big deal because remember a few minutes ago where we said that if you just applied this $100 a month towards your mortgage payment that it would save you about $18,000 or $19,000? Well, which one would you rather have? Would you rather save $18,000, or would you have a stock market account with $170,000 in it? It's a no-brainer. You want to have the $170,000. So with that being said, what's sort of the break-even point? Because obviously the $170,000 crushed this $18,000. So if your goal was just to take the money out of the stock market once you were able to actually pay off your mortgage, when would that be exactly? Well, if you had taken this $100 a month and invested it for about 21 and a half years, that money would have grown into roughly $85,000, with about $59,000 of that being profits and the rest being your actual contributions. And the reason I separate it out like this is because unfortunately you are going to have to pay taxes on your profits. That roughly $59,000 in profits, you're going to have to pay taxes on that. Now, thankfully, you're probably going to be paying long-term capital gains tax on this stuff, which is very, very cheap. It's why investors and millionaires and billionaires typically don't pay a lot of taxes, because for most people, long-term capital gains is only taxed at 15%. So if you are going to get taxed 15% on this roughly $59,000, that would be, give or take, $8,900 in taxes that you would pay. So if we subtract roughly $8,900 in taxes from this total, this $85,000, that leaves us with roughly $76,000 in this brokerage account after 21 and a half years. So if you look at this sample amortization schedule that would have started in January of 2021, roughly 21 and a half years later, you would only owe roughly $75,000 as a balance on this original $200,000 loan. So you owe $75,000, but you've got $76,000 worth of after-tax money sitting in this brokerage account. Just take the money out of your brokerage account and pay off your balance in full on your mortgage. So by just taking the $100 and applying it directly to your mortgage, we were able to save 4 years and 9 months off of that mortgage payment. But by taking that $100 a month and letting it grow and compound, we were able to pay off that mortgage 8.5 years faster at only 21.5 years. So that's relatively close to twice as fast as just paying that money directly towards your mortgage. So what are the pros and cons of doing it this way as opposed to just putting the money directly towards your mortgage? Well, the first thing is it does take a little bit more self-control to do it this way. Because when you pay that $100 to your mortgage company, you're not ever going to see that money again. It's kind of locked away, tucked away where you can't touch it and you can't mess it up. But for some people, if they see thousands or tens of thousands of dollars in this brokerage account that they have access to whenever they want, they might be tempted to just start using that money for other things rather than actually paying off their mortgage. Maybe they want to buy a nicer car, or maybe they want to take the family on vacation to Disneyland. It's very easy and tempting to start using that money for other purposes. So you do have to have some self-control. And the other risk is that, of course, the stock market is volatile. Some years it's up, some years it's down, so results are never technically guaranteed. Now, some of us remember back to the 2008-2009 crisis where, everybody was struggling, the financial world was in ruin, and everybody was just having problems. But if you look at this stock chart for VTI, the Vanguard Total Index Fund that realistically I would recommend most people invest in, it's a very safe, broad stock market index. If you look at 2008, this little blip where the market turned south and lost some money, you'll notice that in the years that have come after that, we have more than made up any losses. The same thing holds true for April of 2020 when COVID hit. You'll see this massive drop right here, but we have recovered. The key takeaway in all of this is that given enough time, the stock market will recover from whatever crash happened. The only time that you lose money during a crash is if you panic and you sell. If you had just held on to your assets during the 2008 crash and you held on to your assets during the COVID crash, then you would have came out just fine. All you have to do is remember that eventually the market will recover. Do not panic and sell for a loss. So that's going to wrap it up for us today, folks. Some of the best ways to pay off your mortgage as rapidly as possible to achieve that financial security that we're all looking for. If you enjoyed this video, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time.